Hey guys, Mike here. So I hope everybody's having a good day. Hope you enjoyed the last two videos. Thank you for watching those. Make sure you watch tomorrow's video because that is one of the craziest videos I've ever researched. And boy, it'll explain a whole lot to you. That is for sure. And it'll make a light bulb come on. But today, the one thing I'm noticing, and before I even left on vacation, all I heard was, oh, we're in a recession now. People are saying we're in a recession right now. And I believe in, yes, we're doing rolling recessions. Like manufacturing is abysmal, right? The housing market may feel like in a recession because nobody's selling the homes they live in and all this good stuff and can't really afford the ones they want to try to buy. So, for sure. But there's things I do, and I try to do like a members video at least once a month, maybe once every 2 months, showing like a lot of indicators that you can see and look at to kind of block the noise out and just say, maybe, not really. And don't forget, as 2022 showed, and I'm going to show you this, the market can crash without a recession, right? The reason why they crashes in 2022, and you'll see it right here, because they thought there was going to be a recession. I will show you why they thought there was going to be a recession. Okay, a lot of these indicators were doing what they normally do right before a recession hits. And then two, there's usually a trigger for the recession, right? We call it the dot-com bubble, the great financial crisis, right? All that stuff starts to weigh on stuff and things start to break. This is what we mean when we say the Fed holds rates too high for too long until they start to break some. That is usually the event that triggers the whole recession. But these indicators will be lining up going into that, okay? So just FYI. And so we'll go through them as fast as possible. You can look at these. I got all these in TradingView, so they're free to everybody to see and have and everything else. And just let me know what you think. If there's certain things you look at and understand, you will never be able to predict a recession. If you can, let me know in the comments how you do it, what you use, because I'm telling you, but you can at least have indicators that go, oh, I really need to be on the watch for this. This is getting rough, right? We're fixing to probably go down, right? So again, just keep in mind on that. Now, going through this really quickly with you, just a few things here. And again, these are not in any certain order. You can look at this. One is going to be Dow Jones Transportation, right? The transportation normally will start heading down before we go into a recession. The reason why we know that, when we look at the last recessions, again, you can't count 2020 because that literally was shutting down the world. But when you look at any other time, this is the case. And you can kind of see what was happening here. We thought we were going into a recession basically right here when it started to go down. I was like, oh, this is it. Transportation is looking horrible. And then it ended up kind of bouncing back, right? And so, again, when you look at this, here's 2022 as they sold us down. But, it's one of those things, even before they sold us down, it was going down, right? It was already starting to sell down before the market sold off in January. All right, so they said, oh, okay, let's just sell it down. And normally, if you go back to 08, you go back to .com, you'll see what I'm talking about. It starts to go down because this is how we get everything around the world, right? This is how we get everything around. So if FedEx, UPS, and you have to look at what's in the transportation, by the way, you'll see why. This is one of those things to look at. It's kind of like a red flag indicator. Now, next one here, you can see this is kind of a weird one. This is the gold-silver ratio. What's interesting about this one is you see which way it's going now, right? S&P is going up, gold-silver ratio is going down. Look in 2022, though. The gold and silver ratio was going up, right? And you can see when they sold us off in 2022, it kept going, okay? And so these are going opposite directions. But when you go back to actually real recessions, if we try to go back here, you can see as the S&P is coming down, what's gold-silver ratio doing? It's slightly down, basically flat, and then just spikes like crazy, right? As we get the major drops. See the divergence here going into the dot-com bubble? So you will start to see this. If you go back even farther, you'll see some other recessions. See how it's going up before the recession? And so you kind of get an indicator on this. If you start to see a major move in this ratio, it means the market could be heading down very fast, okay? Another one, HYG. This is junk bonds, right? This is the high-risk stuff in the bond market. Bond market is the smart money, okay? These people do this for a living. They manage risk for a living. Right now, it's going up. Still green, heading up. And so, again, I would watch at these levels I got marked out here on the chart right here. You start breaking these levels, then it's something to be worried about. But when you look at this, sometimes what will happen is it will trigger a sell-off or at least start setting like equal highs before the market starts to sell off. Okay, so it's just something to keep in mind. Very important. Now, QQEW, this is another one. It's the equal weighted ETF for the Qs. I'm putting it on the Qs just because the Qs have been leading the way like crazy with these, 10 stocks and the AI pump and everything. And when you look at it, a lot of times what happens is this will sell off before the major market sells off because there's so much concentration in those larger stocks. And so it kind of gives you a warning, okay? So you have equal highs or it'll start to sell off beforehand. You can see it right here. All right, and even in 2018, it technically wasn't a crash because it wasn't more than 20%. You saw the same thing going on where the Qs were still going up and the QQEW could not break that other high. It's at a lower high, okay? So make sure you pay that close attention. And when we go to 2022, same thing. Like you saw QQ running up and the QQEW setting lower highs before the crash, okay? So just, and you can use the RSP as well. That's the equal weighted for the S&P. I'm just putting this on here because of what's going on with this AI pump, and the Qs have been the one really benefiting from that more than anybody else. Now, going into some other importance real quick, you got this one right here. This is your manufacturing new orders, right? Manufacturing has been in a recession for quite a while now. Under that white line is contraction. You can see the cycles. This is how it goes right here. Okay, 2020 destroyed it. See what it did right there? And so the cycles are all jacked up. What's supposed to happen, this is supposed to roll back up if we're into a new cycle, right? That's what's supposed to happen. Right now we're in contraction. You go over here to Chicago PMI, contraction, right? You can see the cycles to the left right there. It's plain Jane to see. All right, now I would highly recommend you track these because that's how the market goes. The stock market follows these cycles too. You got right here the ISM Purchasing Managers Index, still in contraction. Here we go with residential property prices. This is one of the major problems. If you look right here, that's where we're at. Usually, you know, you're running up, right? Now, if you look closely, and then of course before the recession, they drop. If you look right here, that drop, that little drop, that was 2020. That was right before 2022. Okay, and that's what normally happens before a recession. But unfortunately, that's just not happening. And when we bring up the inventory, this is why it's just not normal like it's been in the past, right? We'll add this in, you'll see what I'm talking about with the inventory of houses in this country. You can see clearly this goes right back for the dot-com bubble. Inventory is going up, which was normal. Housing prices were still rising. And then after 08, we destroyed a bunch of people and they got their houses evicted and foreclosed on. Inventory has just been going down ever since, right? And so it's going to be really hard unless inventory starts to pump back up, right, to start bringing down prices dramatically, right, without a a recession. that's just the truth. I mean, why wouldn't? Right? People have to lose their jobs in order for inventory to start going up because they get foreclosed on, all this good stuff, and the housing prices start dropping because people aren't buying at all, okay, when they start losing their jobs. Now, the money market funds, you can see it's way up here. Look at that rise right there. Insane rise in such a short amount of time. That's literally like 1 year, okay, that rise is. Versus normally it's between like a 3 to 5 year span going up. And if you look when we go in recessions, that number continues to go up. Do you know why it continues to go up? Because people start getting out of the stock market and rotating this stuff, the big boys, especially the rich folks, into these money market funds where they can just get their 5% on their millions of dollars. And so, you know, it's not done going up, actually. And it's hard to drain this stuff out of the economy. This is what keeps a lot of people afloat right here, not like people that make $50,000 below. All right. And so I'm talking about people making like, you know, 100, 150,000 and above up to $1 million, $2 million. Now, you're going to hear about this one, the yield curve. When it gets above that zero line, that's when things get interesting. Okay. That's that white line. They've been trying to uninvert, right? But when you look, this is when things get broken. Normally, right here, okay? We are not above that line. The problem is, will it be normal? Will that white line be the same? Because we were in the deepest we've ever been in this inversion, okay? And if you actually have this chart, you can look at it. When you look at it, the 2022 crash happened because it started to uninvert, and they thought, oh my God, here we go, things are going to start breaking. Because when you go back and look at a lot of these charts on the 2022 time frame, right before they crashed us, it was looking like, oh my God, we're going into a recession, all right? Now, unemployment rate starting to finally tick up from 3.4 to 4.1. This happens normally for a recession, but it gets to a certain point where it'll really start to accelerate, and that's what you got to watch out for, okay? You really got to watch out for that. Now, this is a ticker I basically created which has 8 of the large major companies all benefiting from AI, all that fun stuff. And so when you look at this now, again, when it falls, put the 200 moving average on here. When it falls below the 200 moving average, just pay attention to it. It's way above it now. That's when bad things are really going to happen. And we are super stretched, for the farthest we've ever been away from the 200 moving average. But instead of trying to track each ticker, if you can't do that, just track one symbol and say, because you can see 2022, when it dropped below, it came back up, retested, fell, and then collapsed. If these stocks obviously collapse, the market's going to collapse with it. Okay, I've said it for 2 years. The stock market cannot take a 20% drop without these stocks going down because they make up almost 40% of the Qs. They make up at least, what is it, 35 now, 35%, if not more, of the S&P. And so, again, and it might even more than that on the Qs now because I forgot I'm including 8 tickers here. But, again, it's something to look at. Normally, it used to just ride the 200 up. But since this AI pump, you can see it hadn't touched the 200 since the beginning of 2023. So, been a year and a half right now. And so, again, you know, 35% above on these stocks. We'll see how much more that can go. And then when you look at just a few others here, make sure you pay attention to this right here, okay? Most people don't talk about this. I like to talk about this kind of stuff. It's the ratios. XLU, which is utilities, compared to the SPY. You can see in this beautiful little chart right here, it had been bouncing up and down, back and forth and all that stuff. When it's going up, all right, that means they're rotating into defensive areas, okay? You can see that in 2008 crash. You can see it in the dot-com crash, right? Where is it at now? It's down at the bottom. It's actually being pushed down even more, going into this little color area right here, okay? So when this thing starts to spike back up, that's when you know, uh-oh, wait a minute, they're going really defensive, okay? When you go over here, you can see I got all these ratios right here for you. XLP, this is the stuff we absolutely have to have. Right now, it's down in the dumps compared to the SPY, right? You can see, shoots up in 2008, shoots up for the dot-com bubble, okay? So it'll start to spike up. It has not done that yet. That does not mean it ain't gonna happen. Okay, we've seen days where we've had it. But I'm talking about major rotation, okay? You go over here to XLV, healthcare, another defensive area, okay? This right here is actually finally falling below that little blue area right there. But you can see it'll spike up too. It's defensive because why? You have to have groceries, you have to have utilities, you have to have healthcare, even the worst of times, whether you're paying for it or whether the government's paying for it. That's the way it works, okay? Now this is consumer discretionary, the stuff we don't need. When it starts to plummet, and normally you'll see it before a recession, these are your Nikes, your Lululemon, $300 pair of, underwear, whatever it is they sell, then that's what we're talking about, your Rolexes, all that fun stuff. Right now, it's not doing that, okay? It can happen quickly, but it's not doing it. The other one, financial conditions. Been talking about this one for 3 years now. Right now, it's been loosening for a long time. When you go to this chart right here, there's something I upload, every week for the members just to track it. When it's going up, we're tightening. When it's going down, which has been going down for a long time, that means the market's probably running hot, right? And it's been running hot, right? This is the other one. Make sure you pay attention to what the banks are doing, okay? If they're tightening, this chart is going up. Normally, we tighten going into a recession. If they're tightening on commercial loans, personal loans, all that fun stuff, credit cards, you're going to see it in this chart. It's updates every 3 months. So some of these are lagging indicators. Be very aware of that, okay? Be very aware of that. And, of course, a recession is also lagging because these indicators will be going up way before we hit a recession. But when you look at it, it goes up before a recession. So make sure you can go into TradingView. You can upload those. You can go back, and you'll see it because when it's going up, that means the banks are tightening. Where do we get the majority of our money? From the banks, especially, companies, right? So if companies can't get the money out, that means they can't do new projects, can't pay their employees, all that fun stuff. And so you got to keep it in mind. Don't forget, especially you're looking at more of the smaller businesses because that's what employs almost 50% of the country is smaller businesses. And they're going to get locked down on them real fast. They're not going to worry about Meta and Microsoft and Apple as much, right? They're going to give them whatever they want. But smaller companies, right, who don't have that kind of capital and 80 billion sitting around in cash, it's a different story, okay? So make sure you pay close attention to that. I do find another thing. My neighbor told me he's a construction supervisor and he builds all these big projects and stuff. And he said, if you start seeing a lot of apartments and self-storage buildings going up, which we have seen, then that lets you know companies are looking for a recession on the horizon because what happens in a big recession? People lose their jobs, they lose their houses, they have to downsize, right? So they go into apartments and they go into self-storage to put the stuff in the house, right? And so it makes sense. I never thought about that. So you can watch stocks like Equity Residential, and then I cannot think of the name of the storage unit. God, if you just type in TradingView, public storage, that's it. If you look at that stock, you can see it. If those are going up, normally they hold up very well in a recession, but they'll usually be going up before the recession because the companies are forward looking, right? They're trying to get these things built now. So that was kind of a weird one, but I just want to put it out there to you. So anyway, at least when you look at that stuff, and it takes you, 2 minutes to let it go down, 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 down. Once you know what you're looking for and go, I see no indicators. Now again, that don't mean the market won't crash without a recession. We saw it in 2022. So if the market thinks it, right? They may have thought that in 2018 as well. That's why they put it down almost 20%, right? And so, we'll have to see. But we'll have to see what's going on with rate cuts and the Fed and all that stuff because they're looking at employment very close. If you heard Powell talk last week, like I said, he is looking at employment very, very closely now, a lot more than they used to. And that's why they keep thinking about these cuts coming soon, right? Not to mention all the other central banks around the globe are pretty much cutting everything. And inflation seems to be coming down, even though I guess maybe 3% is the new 2%. Who knows? But, that's a whole different ball game. So hopefully you got something out of that, like I said, I try to put this out once a month or at least once every 2 months if it's called for, and see that, at least know what's going on, right? So I don't want you to be blindsided on something. So anyway, so make sure you watch tomorrow's video, so it will put a light bulb on for a lot of you, and it will explain a lot. It put a light bulb on for me, and I've been doing this for 3 years, and I'm all about pulling back the curtain, but it makes a lot more sense when you see how the market is acting, especially now. So anyway, hope you got something out of it. Please hit the like and subscribe button. Really appreciate it. Share the video if you're kind like that, and I will see you tomorrow.